The U.S. surplus lines market has always been a closely watched segment in the global insurance industry, given its key role as a gauge between the admitted and seemingly more complex non-admitted markets. A shift in business favoring the latter segment in 2019 would tend to underscore a hardening insurance market in terms of rates and conditions based on AM Best annual deep dive into the sector. I'm John Weber for AM Best TV. Here to discuss AM Best recently issued surplus lines report are two veteran observers of the surplus lines sector, Associate Director David Blades and Associate Director Robert Raber. And David, let's start with business volume in 2019 and what the indications were there.
Well, John, U.S. surplus lines premium volume increased considerably. In particular, U.S. surplus lines companies that write more than 50% of their total business on a surplus lines basis increased their direct premium written by almost 15%, the highest level of growth since 2006. This spurred the entire surplus lines market, including business that's written by the Lloyd's market syndicates, to grow by 11.2% in 2019, which matched the level of growth in 2018. Premium growth that we saw in 2019 reflected the ability of surplus lines companies to take advantage of market dislocation, as many of the standard market companies that have been deploying available capacity to compete for risk with borderline or true surplus lines risk profiles sort of took a step back and began to take a harder stance on some of that business because of profit and loss concerns. The pulse of a healthy surplus lines market is reflected in the business being processed by the 15 surplus lines stamping offices around the country, and the year-over-year increase in not only premium volume, but also in the number of transactions that are processed or that were processed in these offices was evidence of a strong flow of surplus lines business in 2019. The vast majority of commercial lines of business, save for workers' compensation most prominently, were experiencing upward trends in renewal pricing, and companies were writing new business at higher average premium levels as well. And that also had a positive impact in terms of premium growth for surplus lines companies. Property accounts, particularly catastrophe-exposed property risk, commercial automobile, commercial trucking risks, primary general liability, umbrella, and excess liability coverage, and professional liability lines like D&O and E&O were also experiencing higher premiums on average that were aimed at counteracting adverse loss frequency and severity trends and achieving better rate adequacy. And all of these in total helped spur the premium growth that we saw for the surplus lines market in 2019.
Now, the insurance industry overall was reminded rather quickly what a difference a few months could make. AM Best changed its outlook for the surplus lines sector to negative in April amid the COVID-19 economic impact. Can you take us through the reasoning behind that and where things stand now, David?
Okay, sure. AM Best's decision to revise the outlook of the surplus lines industry or market segment from stable to negative in early April largely reflected the economic disruption in the U.S. stemming from the COVID-19 pandemic and the effect that we expected the contraction in the U.S. economy would have on the surplus lines market. Now, you may recall that it was only a month prior in our 2020 review and preview report that we maintained the stable outlook for the surplus lines sector, citing market conditions that we believed, although dynamic, would remain supportive of premium growth for the sector, also favorable underwriting performance and maintenance of the strong risk-adjusted capitalization for the surplus line segment. Now, reflecting on the decision to revise the outlook to negative, AM Best believes that there's a direct link between the healthy U.S. economy and the demand for surplus lines insurance products, particularly for new and emerging markets. And following the onset of the pandemic, the degree to which we saw small businesses being hurt in particularly had a distinct and meaningful impact on our decision ultimately to revise the outlook to negative. AM Best has, I must mention, has been somewhat surprised at just how resilient, though, the surplus line segment has been in terms of how the companies are faring during this ordeal, to this point, based on what we're hearing from our rated companies. And our plan is to see how things play out for the rest of the year and then update that outlook again during the first quarter of 2021.
Robert, how would you characterize the flow of new business submission into the surplus line sector in 2020? Did it change after COVID-19 began to impact the economy?
The flow of new business has definitely changed in two different directions. First, there was a temporary decline in new business coming to the surplus lines market beginning with late March and into early April as those stay-at-home and shelter-in-place orders were implemented across the country. The advantage to the insurance industry is that many insurance companies, brokers, agents were deemed essential. So people who still needed insurance could still reach out to their companies, their agents, and still obtain insurance. Very quickly, we saw the surplus lines market recover as far as submissions for new business is concerned. One reason is because the dynamics that we've seen in the market recently, transitioning to harder market conditions, continued. So there was still a need and demand for certain sectors of the surplus lines market for insurance. One area that we were monitoring was with insureds that are artisan contractors, plumbers, carpenters, people who come and work on your house. As the COVID-19 shelter-in-place orders played out, more people wanted to spend money on their homes. So this was a market that there was a demand for insurance because these artisan contractors continued to work, and in some cases saw more business volume than they've ever seen before. So they needed to ensure that they had their coverage and ensure that their coverage was maintained. So that was a portion of the market where demand stayed high. Currently, surplus lines companies are reporting new submissions at some of the record paces that they've seen over the last 2 to 3 years. This is also continuing to be part of those hard conditions that we saw. We know that these companies are showing this high demand. One is because the publicly traded companies are announcing it in their quarterly filings and their earnings calls. We know, as David noted, the stamping offices that are giving us volume results into June of 2020 are showing that there continues to be activity there. And in our interactions from the rating side with companies, they're reporting to us that there continues to be demand for surplus lines coverage. From a rating perspective, though, even though we know that submissions are very high, we're still focused on companies with their quote and their bind ratio so that we know that they're staying true to their underwriting discipline that they developed before the COVID-19 environment.
What's happening on the rate side, Robert?
Oh, rates are continuing to rise, and I think AM Best's expectation is that conditions are going to persist in the short term for continuing rising of rates. It continues to be a hardening market position. The established carriers have continued to look at their risk tolerance and appetite. They continue to look at programs that they're writing that might have poor loss experience. They're just choosing to release some of these programs, non-renew, let it go out into the market. We're seeing that both from admitted carriers with strong positions in the market and even some surplus lines carriers who have maybe changed their risk tolerance appetite. Putting all this business out in the market, releasing it in the market, allows the new companies that are pricing it to get what they believe is the most adequate rate. So these conditions are hardening. I wouldn't call this the hardest market we've ever seen, but it's definitely a hardening market. The advantage really for the surplus lines underwriters is they can take that underwriting acumen and they can complement it with how they use data. There's more data available to these companies than ever before, and they're able to mine it so that they can get the right rate and the right price on the programs and risks that they're putting on their books.
What does AM Best anticipate for this sector in the balance of 2020, David, and really heading into 2021 as well?
Well, John, I think, from an anticipation standpoint, I think, based on what we've seen, I think we expect the surplus lines market to continue showing its resiliency. I think AM Best will continue to monitor the surplus lines market and how it continues to combat the challenges brought forth by the pandemic and how different lines of coverage and risk classes that are typically within the sweet spot of surplus lines companies are being affected. We're currently aggregating industry data for all market segments through the second quarter, and we'll compare the aggregate financial indicators for the surplus lines companies along with the results of the individual companies on a quarter-to-quarter basis and year over year through the first half to ascertain exactly how they're doing. The current impasse in Washington concerning the anticipated next stimulus package and how that affects the economy and the insurance market is also something that we'll continue to bear watching. But again, like I said, I think we continue to think that the surplus lines market will show its resilience as it combats some of these challenges. We'll also continue surveillance of some of those areas such as private flood, property coverage in wildfire exposed areas, cyber liability and professional liability that have borne opportunities for surplus lines companies to meet the challenges in the changing market demand. For these classes of business, we'll look at whether the market dislocation continues to help those opportunities remain plentiful. And I think Robert actually also has some other forward-looking thoughts as well.
When I think about looking at the surplus lines going forward, from the analytical perspective, I kind of think about the framework from our rating building blocks and how we look at, how we assemble an AM Best rating, for a company, and thinking a little bit about how we would look at companies' balance sheet strengths. We'd want to make sure that companies are maintaining the capital for the risk that they're putting on their books. Even though a lot of the top line is rate, companies are putting more risk on their book. We want to make sure that they have a capital supportive of that. One of the concerns I think that's going on throughout the industry with the COVID-19 conditions is what may happen to investment portfolios if investments credit quality is downgraded across your investment portfolio. Will companies be able to insulate their assets if that occurs? Thinking about operating performance a little bit, there could be some shrinkage in cash flow as premiums decline. If a surplus lines company is writing in a market that might shrink, they may have had a great niche, but maybe that's the portion that's impacted by the economy. We're also not sure about how some claims trends are going to expand. The industry talks a lot about business interruption, but we don't know how other parts of the claims environment may be impacted. And every claim that's filed, there's going to be some expenses incurred to either deny it or defend it if it goes to litigation, and that increases your expenses. Thinking about the business profile, how are the surplus lines companies going to be able to sustain that niche for that specialty market that they have, if that's the area that's impacted by the macroeconomic conditions? And then thinking forward on that, will companies have to accelerate how they're applying innovation to their operations, their distribution, their services, or to help spread their brand? And then the big picture, really, the ERM, did COVID-19 cause you to reevaluate your risk appetite and tolerance? Did you have to look at your business through a COVID-19 lens? Did you have to change your perspective, or did you find even any weaknesses in your ERM from the COVID-19 environment? So I think those are the things that we're really going to, from a rating analytical view, want to know from surplus lines companies as we go forward for the rest of this year and into 2021. The word I think I've heard the most in my company meetings is pivot. Companies talk about how they had to pivot. I think we're going to hear that word a lot going forward, talking to them about surplus lines companies about how they manage the COVID-19 environment.
Thanks, Robert. David?
You're welcome, John.
Thank you.
You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.